Hi everyone and welcome to chapter 15. In this recording we are going to discuss about debt financing. So in the last chapter we discussed how to raise money from stocks. In this chapter we are going to discuss about how to raise money from debt. So chapter outline, it discusses what is corporate debt, what are other types of debt, what are bond covenants, what are restrictions that bondholders generally put, what are repayment provisions. Okay, learning objectives that we are going to cover: identify different types of debt financing available to a firm, understand limits within bond contracts that protect the interest of bondholders, describe the various options available to firms for early repayment of debt. So what is corporate debt? Corporate debt is a company, a firm raising money from outside, right? Corporate debt is a firm raising money from outside in form of in kind of loans. So what is loans? Loans is where you pay interest and you pay your principal. Now that can be structured. You pay regular interest and principal, or you pay regular interest and finally you pay principal, or you pay everything at the end. So the structures can differ, but the basic underlying principle is when you issue debt, you pay interest. So there is private debt and public debt. Private debt means this debt is not traded on public debt markets. Okay. So private debt can be bank loans. Bank loans can be term loans. Term loans are like normal loans that you and me take. So 5 years, 10 years period, and you pay principal and you pay interest payments. Or it can be bullet loans, right? Or so they are called as bullet loans. Bullet loans means you do not pay regular interest. Everything happens in the end. So let's say it's a 5-year bullet loan, right? So you do not pay regular interest for 5 years. Instead of that, when the loan matures, you make an means at the end big payment. So bank loans can be term loans, syndicate bank loans, revolving lines of credit, asset-backed lines of credit, or it can be private placements. So let's go one by one. So what's a term loan? Term loan is normal loans that we have, right? It can be where you pay regular interest and principals, or you pay interest and principals at the end. Syndicated bank loans means sometimes the loan book size is so big that one bank cannot sponsor it. Let's say like GM Motors in 20 means from period of 28 to 2015, they raised around $13 billion in loan. So it is very difficult for one bank to give out $13 billion worth of loans. So a lot of banks come together, they form a syndicate, and then they give out loans. Then revolving line of credit. What is a line of credit? Line of credit is where you do a credit is extended to you. So let's say I get a line of credit. I am a firm. I get a line of credit of $1 billion. Do I pay interest when the credit is extended? No. But if I use that credit, if I withdraw from that money, so it's like a credit account. So you have $1 billion in your kitty. Whenever you need money, you can withdraw money from that credit line and use it. But whatever you withdraw, you have to pay interest on that. So that's a credit line. So it can be revolving line of credit where the credit line revolves, right? It gets renewed every year or every 5 years. And asset-backed line of credit. Asset-backed means instead of line of credit that is not backed by anything, banks may want certain collateral to be put. So let's say I'm a car dealership. I can put collateral, whatever cars I have in my inventory. I can put those cars value as collateral and borrow against it. So asset back means there is some kind of asset that is kept as collateral. Private placement means instead of going to banks, you go to wealthy institutions, right, or wealthy individuals and extend debt to them. Public debt means your debt is being issued to normal investors, to public debt markets. Now one thing to remember, public debt markets are much bigger than equity markets. So in Canada it is more than $6 trillion right now. So it is much bigger than market cap of Canadian stocks. So whenever you raise public debt, you have to give a prospectus. Prospectus has indenture, which is a formal contract between bond issuer and a trust company, which represents the bondholder's interest. And original issue document bond, a coupon bond issued at a discount. Okay. So what does this mean? So whenever you're coming to public debt markets, you have to file a prospectus with bondholders. So what is a prospectus? It's a formal contract between bondholders and the trust. Trust is going to oversee that bond. So that trust is going to take care of bondholders' interest. Now public debt can be unsecured corporate debt or secured corporate debt. What is unsecured corporate debt? Unsecured corporate debt means that it is not backed by any asset. So they just have a general claim on the company. They do not have a specific claim on assets. General claim means they can, if you default on that debt, you can be sued. They will sue you. They'll ask for money, right? But where will that money come from? That money will come from general assets, like all assets of the company, right? It will not come from specific assets. Secured debt means there is collateral that is put. Now, in terms of interest rate, unsecured debt has a higher interest rate because it's unsecured. There is no specific asset that is kept as collateral. Secured corporate debt is having lower interest rate because there are assets that are put as collaterals. Unsecured corporate debts have notes. Notes are generally short-term debt instruments. And debentures. Debentures are long-term debt instrument. And secured corporate debt can be mortgage bonds. Mortgage bonds are generally issued by banks. So banks have loans which are assets. Loans for banks. The bank gives out loans and earns money on that. So for banks, loans are its assets. So against that loans, it will give out bonds. So it is bonds raised against loans. That is why it is called as mortgage bonds. And asset-backed bond means any other company except bank, right? Whatever asset it has factories, it has, let's say it's a car company like Tesla, it has cars, inventories, then it can borrow against that inventory. Now, in corporate debt, seniority is important. Seniority means when the company defaults, what is your seniority in terms of payment? Like when the company defaults, its assets are sold. Then out of those assets, whatever money it gets from that asset, first payment will go to the highest seniority debt. So if the debt is having very high seniority, the first payment goes to that debt. Once those debt obligations are fulfilled, then they work themselves down. So senior debt has lower risk than means not so senior debt. So if you have a debt that lies at the bottom end or in terms of seniority, that has very high risk, right? But if a debt has seniority in terms of payments, it has lesser risk. So bondholders' priority in terms of default in claiming assets, not already securing other debt. So it is priority of debt payment. Subordinate debenture, a debenture issue that has lower priority claims to firm's asset than outstanding debt, that is called as subordinate debenture. Means it has lower priority in terms of payments. Tranches, there can be an instant where a firm create different types of tranches. So it is different classes. So they can create class A debt, which has very high seniority, class B debt, which has moderate seniority, and let's say class C debt that has very low seniority. Okay. Tranches, different classes of securities that compromise a single bond issuance. Now, public debt can be issued in forms of domestic bonds, foreign bonds, euro bonds, or global bonds. So let's discuss one by one. So what is a domestic bond? It is issued by a local entity and traded in local markets but purchased by foreigners. So it is generally issued by a local entity, so a Canadian firm, and it is traded in Canadian markets but it can be purchased by foreigners too. It is denominated in local currency. So example, a domestic bond will be a Canadian company issuing bonds in Canada, right, that are issued in Canadian dollars. That is a domestic bond. Foreign bond, It is issued by a foreign company in local market and intended for local investors. Example will be an American company issuing bonds in Canada, right, for Canadian investors and issuing it in Canadian dollars. It is denominated in local currency. Foreign bonds, they are called as Yankee bonds. If a firm that is outside United States issues debt in United States, those bonds are called as Yankee bonds. If a firm that is not Canadian and issues bonds in Canada, those are called as Maple bonds. Same way, if a firm is not Japanese and they issue bonds in Japan, then those bonds are called as Samurai. And if a firm is not UK based and they issue bonds in UK, those are called as Bulldog bonds. Euro bonds, international bonds that are not denominated in the local currency of the country in which they are issued. For example, if a Canadian company issues bonds in Canada, but the currency of issue is, let's say, US dollars, or let's say it is Japanese yen or European euro, then in that case, those are called as Euro bonds. Global bond combines the features of domestic, foreign and Euro bonds and are offered for sale in several different markets simultaneously. They can be offered for sale in the same currency as the country of issuance. So it's a combination of features of domestic, foreign and Euro bonds. Key terms that you will come across: private debt, debt that is not publicly traded; term loan, a bank loan that lasts for a specific term; syndicated bank loans, a single loan that is funded by group of banks rather than just a single bank; private placement, a bond issue that does not trade in the public market but rather is sold to a small group of investors; indenture, a formal contract between a bond issuer and a trust company that specifies obligations of bondholders; unsecured debt, a type of corporate debt that in the event of bankruptcy gives bondholders a claim to only the assets of the firm that are not already pledged by collateral. So it has a general claim, it doesn't have specific assets that are kept as collateral. Securitized debt, secured debt, a type of corporate loan or debt in which specific assets are pledged as collateral and bondholders have direct claims in those assets in case of bankruptcy. Mortgage bond, a type of secured corporate debt in which real property is pledged as collateral. So mortgages are kept as collateral. Asset-backed bonds, a type of secured corporate debt in which specific assets are pledged as collateral. Seniority, a bond's priority in event of default in claiming assets not secured by other forms of debt. Subordinate debenture, a debenture issue that has lower priority claims to firm assets than outstanding debt. So seniority means how senior is your debt. Subordinate means it has lower priority. Tranches, different classes of securities that make up single bond issuance. Domestic bonds, bonds issued by local entity denominated in local currency and traded in a local market, but they are purchased by foreigners. Foreign bonds, bond issued by a foreign company in local market and intended for local investors. They are denominated in local currency. Euro bonds, international bonds that are not denominated in local currency of the country in which they are issued. Global bonds, they have features, bonds that are offered for sale in different markets simultaneously. Sovereign debt, what is sovereign debt? Sovereign debt is government debt. So sovereign debt is a debt issued by the national government. Agency securities, this is debt issued by government players but not directly by the central government. So example, agency securities are issued by crown corporations of Canadian federal government. So whichever crown corporations, public sector is there, if they issue debt, that becomes agency securities. Provincial and municipal bonds. Provincial and municipal bonds are issued by provincial and local governments and their crown corporations. Example, Manitoba Hydro or Hydro-Quebec. Now, general obligation bonds backed by the full faith and credit of local government. So these are bonds that are backed by general credit rating of the local government. So example, bonds issued by Alberta that are not specifically linked to certain assets. Double barrel bond, bond with payments tied to a particular revenue source in addition to full faith and credit of local government. Example, if Alberta government issues oil bonds which are backed by oil payments, then in addition to Alberta's credit rating, they are also backed by a specific resource. So in that case, it is called as double barrel bond. Revenue bond, bonds backed by revenues generated by projects initially financed by bond issues but are not backed by full faith and credit. So revenue bond means they are related to specific projects. So let's say there is a Hyperloop terminal that is planned between Calgary and Edmonton. So bonds that are issued for specifically that project, those are called as revenue bonds. So coupon payments on real return bonds. So what are real return bonds? So I'll explain in Excel and then we can come back here. I'll open an Excel. So real return bonds are bonds that are bonds in which face value adjusts to inflation. Face value adjusts to inflation. So let's say $1,000 is the face value. The bond is issued. Okay. Coupon payment is 2%. Okay. So in first year, you will get $1,000 into 2%, that is $20 in coupon. Next year, let's say the inflation is, we have one more column of inflation. So first year you get coupon payment, but now inflation is 2% or 3%. So what will happen? This was the face value. This face value will adjust to inflation. So this will grow by 1 plus inflation. So this will become 1030. You are paid the same coupon rate. So coupon rates don't change, but the face value keeps on changing. So how much will you get? 1030 into 2%, 20.6. So your coupon payment goes up, even though the coupon rate stays same, but the face value is adjusted. Third year, let's say the inflation is 2%. What will happen? This will adjust by, or we can just drag because the formula, then 2% coupon and $21 as payment. So each year your payments are adjusted by inflation. How do they do that? By adjusting the face value. And let's say it's a 5-year bond, so it matures in 5 years. So if inflation is 1% here and 3% here, so when the bond matures, you will be paid 1092 instead of $1,000. So face value is adjusted, and finally when the bond matures at the end of 5 years, you will be paid whatever face value is adjusted by inflation. And same way, 2% is the coupon, so your coupon payments also increase. So after having that understanding, let's see what they have done. Suppose that in January 2000, the government of Canada issued a 30-year real rate bond with a coupon payment of 4%. On the date of issue, the CPI was 93.5. In July 28, the CPI has increased to 116. So inflation is measured by CPI. So it went from 93.5 to 116. What coupon payment was made in July 28? What coupon payment was made in Jan 2017 when CPI was 129? So how to do that? Between the issue date of July 2008, the CPI appreciated by a factor of 116 divided by 93.5, that is 1.24%. So what has happened? So ignore the numbers that they have jumbled up. So it has gone from 116 from 93.5. So how to do that? 116.5 divided by 116.1 divided by 93.1, 93.5. Okay, so this is the change of inflation in the given period. So face value was, they haven't given the face value, but let's say it is $1,000 face value. So if $1,000 face value is there, so your face value will become this multiplied by this 1241. So this is the new face value, and you will be paid coupon on that. So this multiplied by 4% yearly coupon. Bonds generally pay semi-annually, so divide by 2. So $24 will be paid to you. How did I find it out? So in 2000, okay, in the year 2000, inflation was 93.5. In 2008, inflation went to, CPI figures went to 116.1. So I noted them down. I found out the change. So 116 divided by 93.5. This was the face value in 2000. This is the face value now. Okay, and face value multiplied by coupon rate by 2%. So let's do it for 2017 too. In 2017, the figure has gone down to 129. The figure has gone up to 129. So what's the change? Always calculate it with the issue date. So 129 divided by 93.5. So 1.37. Face value initially was 1000. The face value now will be this into 1000. So 1379, and you'll be paid 4% divided by 2 coupon on that. So 27.59. Okay. So that's what they have calculated. 1.24 multiplied by face value. Then coupon payment will be into 0.4 by 2. In January, it will be 1000 into 129 divided by 93.5 into 4% by 2. So 27.59. We did it in an easier way. So note down the inflations, calculate the change in inflation from base, always do it by base, right? Face value when it was issued, face value now, and what will be the payments. Next is covenants. Now what is covenants? Now management of a company is hired by board of directors who represent shareholders. So management always acts in the benefit of shareholders. They do not act for the benefit of bondholders, because bondholders don't control management. So that's why bondholders put certain restrictions when they give their money to a company. Those restrictions are called as covenants. So these are restrictive clauses in a bond contract that limit the issuer from taking actions that may undercut its ability to repay bonds. Advantages of covenants. So with more covenants, a firm can reduce its cost of borrowing. So more covenants you have, lower will be the interest that you have to pay. The reduction, because the risk goes down. The reduction in the firm's borrowing cost can more than outweigh the cost of loss of flexibility associated with covenants. Now general covenants that the bondholders include are restrictions on dividend payment, right? If firms pays out too much dividend, then bondholders can be in trouble in the future years, right? Because the profit goes down, the retained earnings goes down. Then they may have restrictions on issuing additional debt. So whenever you issue additional debt, there would be restrictions on that. Then they may have restrictions on mergers and acquisitions. So these are the common instructions that bondholders put. Now call provisions. So what is a callable bond? So I'll explain it on Excel and then we'll go back. So a callable bond is a bond in which the firm can repay the debt before maturity. Callable bond is a bond where firm can repay the debt before maturity. So let's say a firm issued a bond for 10 years, right? Face value was 1000 and coupon rate was 5%. Now this bond was callable after 5 years. So after 5 years, this bond can be called. So call price is always higher than the face value. So let's say it's 1080, can be called at 1080. So what does this mean? The total tenure is 10 years. So if the firm doesn't call this bond, they have to keep on paying 5% interest per year for the next 10 years. But after 5 years, they have an option to pay back, to close this obligation by paying $1080 to the bondholders. So they can call the bonds, pay 1080 and close the obligations. Now when would they do that? They will generally do that when the coupon payments, that is the interest rate, goes down. So bonds are generally called when interest rate goes down. Now why? Because when interest rates go down, instead of paying 5%, the firm can refinance it maybe at lower percent, so 2%. So instead of keeping on paying 5% for additional 5 more years, they can refinance that debt for 2%. So they will call the bonds. So callable bonds have call date, call price and call premium. Okay. Call provisions at bond prices. Investors will pay less for a callable bond than otherwise identifiable non-callable bond, because call is a benefit to the firm. It is not beneficial to the investor. So that's why investors generally pay less. A firm raising capital by issuing callable bonds instead of non-callable bonds will either have to pay a higher coupon rate or accept lower proceeds. Call provisions. Yield to call. The yield of a callable bond calculated under the assumption that the bond will be called on the earliest call date. So yield to call means instead of taking the maturity into consideration, so let's do that. So what will be yield to maturity? There are two yields, yield to maturity and yield to call. So let's say market interest rates are 3%. So what will be yield to maturity? It will be rate, okay, number of years, original duration 10 years into 2, bonds are semi-annual, right? Payments, coupon rate is 5%. So 5% divided by 2 into face value 1000. Let's say you bought it at $1000, okay. Future value, face value is what you return, $1000. Now PV should be negative because you bought it. So yield to maturity will be 2.5% and you have to multiply it by 2 to make it annual. So yield to maturity is 5%, right? Yield to call will be different. So it will be rate. What changes do you do? Instead of taking 10 years, now you do 5 years. Because 5 years the bonds can be called. Payment will be 5% payment divided by 2 into 1000, and this will be 5 into 2 because semi-annual. Present value, let's say $1000. This can be called at 1080, okay, and this you have to multiply by 2. So this is yield to call and yield to maturity. So in calculating yield to call, you have to consider the call period. In calculating yield to maturity, you have to consider total duration. And what is yield to worst? Yield to worst is lower of the two. So whichever is the lowest, it is yield to worst. So yield to call. The yield of callable bond calculated under the assumption that bond will be called on the earliest call date. Yield to worst quoted by bond traders as the lower of yield to called and yield to maturity. So let's see what example they're doing. BCE has issued a callable at par. So face value is 1000, issue price is 1000. 8% bond with an annual coupon payment. The bond can be called, so 100, face value is 100, they have considered 100. So purchase price is also 100. The bond can be called at par in 1 year or any time after on a coupon payment date. So it's a 5-year bond, but it can be called after 1 year. It has a price of 103 per 1000 face value, implying yield to maturity of 7.26. So it's not issued at par, it is issued at 103. And yield to maturity is 7.26. What is yield to call? So cash flows timeline is 5 years. You invest here 103, you get $8 each time, and in the end, in the last year you get $100 back plus $8 coupon. Now what is yield to call? How to calculate that? So yield to call is $108 you get after 1 year. So calls the bond at first available date. At the time it will pay the coupon payment for 1 year, $8 and face value 100. The timeline of payment is thing. To solve, we use the cash flows and set to bond price and solve for the discount rate. So that is what we did. 103 is the price, 108 is the final value, and we discount it. So you get 4.85% as call. So we can even do it in Excel. So they've done that. The YTM is higher than YTC because it assumes that you will continue receiving your coupon payments for 5 years, even though interest rates have dropped below 8%, while under the YTC assumption, you are repaid the face value sooner. You are deprived of extra 4 years of coupon payments. So your total returns is lower. Now there is one more type of call option, that is Canadian call or market call provision. So this call provision sets the call price. So call price is not known. In Canadian call, in normal American calls, call price is known. So when they issue the bond, they say that this bond can be called after 5 years and this is the price. So let's say 1080. But in Canadian calls, the call price is not known. It is calculated. This call provision sets the call price as present value of all remaining payments on the bond, which is calculated using rate that adjusts with changes in prevailing interest rates. The next concept is sinking fund. What is a sinking fund? A method of repaying bond in which a company makes regular payments into the fund administered by the trustee. So what does sinking fund mean? So a company creates a fund with a trust, right? And each year from the profits, they deposit some money into that fund. Now that fund can only be used for one purpose, that is paying off debt. So that is why it is called as a sinking fund. So you sink your debt. So each year from profits, you contribute something to a fund that is kept with a trust, and you can use money from that fund only for one purpose, that is paying off debt. A method of repaying a bond in which a company makes regular payments into a fund administered by a trustee over the life of a bond. These payments are then used to repurchase the bond, usually at a lower bond par value or market price. Balloon payment, a large payment that must be made. So balloon payment means there are no regular payments in the debt, but when the debt matures, you make a big payment. A large payment that must be made on maturity date of the bond when the sinking fund payments are not sufficient to retire the bond issue. Convertible bonds. Convertible bond means these bonds can be converted into common stocks. So two concepts you have to remember: convertible bonds, they can be converted into stocks, and conversion ratio. So how many stocks you get when you convert it. So convertible bond pricing. Consider a convertible bond with $1,000 face value and a conversion ratio of 20. So if you convert the bond into stock on its maturity date, you receive 20 shares. If you do not convert, you receive $1,000 face value. So you have an option. You can either take the face value or you can convert it into stocks. So when will you convert it into stocks? You will convert it into stocks if stock price has gone up. By converting the bond, you're essentially paying $1,000 for 20 stocks, that is $50 per stock. So if the stock price is more than $50, you will choose to exercise your conversion option. Convertible provisions. Convertible bond pricing. So they are different than straight vanilla bonds. Convertible bonds are little expensive than normal bonds. Now, one more thing you have to remember. So behavior of convertible bond. So let's say $50 we have face value of 1000, which can be converted into 20 stocks. So this is face value. This is number of stocks you get if you convert. So price of this bond is 50 bucks. Okay, so share price is 50 bucks. Each share will cost you 50 bucks. Now this bond behaves differently at different prices. So if price is less than 50, it behaves like a bond. Normal bond, it behaves exactly like a bond. If price is above 50, okay, if price is above 50, it behaves like a stock. So it is, the price will go up, go down depending on how the stock reacts. And if it is close to, if price is close to 50, like 48, 49 or 51, then it has features of both bonds and stocks. Okay, and it is most valuable when price is close to 50. When a firm's stock price is much higher than conversion price, the conversion is very likely, and convertible bond prices is close to price of stock. So it behaves like a stock. Convertible provisions, combining features. Company have flexibility in setting the features of the bond they issue. Leverage buyout is a concept when group of private investors purchase all the stocks of a company and finance the purchase by using debt. So that's it for this chapter. See you in the next module.